I think I'm going to hazard a guess that this is one of the most difficult groups of academics to herd. I know academics are always difficult to herd, but I'm having more challenges with this particular group. Thank you, Tita. So we are now 2 minutes past our coffee break time, but we're moving into a shorter session with 3 chapter presentations and a panel. The chapters are on sustainability, genuine savings in developing and developed countries, then on infrastructure, political economy of wealth creation, natural capital, and on intangible wealth, before we will be transferred for what promises to be a magnificent dinner. I might add before we get stuck into it that all of the respondents' comments, lest you feel like we are giving people a brutally short 10 minutes to share their thoughts, they will actually share in a more extended form their comments about the papers, the relevant chapter authors, before they go into the book. This is both serving as part of the editorial process for the Oxford University Press book, and also serving a broader process of sharing these ideas. So, we are moving straight into the Sustainable Century, which is joint work from Matthias Blum, Cristián, Ducoing, and I probably mispronounced that, and Eoin McLaughlin. And I know we have Eoin to come up and present, and Brian as a respondent. I'm glad to see Brian here. 15 minutes, ideally, 20 if you must, and Brian 5 to 10. Thank you very much. Thanks, Eoin.
Okay, thanks very much for inviting us. So what I'm going to present is, I guess, going back to Marty's, well, you're kind of the basis of what we're trying to do. And what we're trying to do here is kind of take a historical look at some of these indicators and construct it for a host of developed countries and developing countries as well. And we've limited to a 100-year period to make it nice and tidy and to give it a straightforward enough title. So a sustainable century, because we could go further back. We in an earlier paper we went back to 1750, but it doesn't translate into a nice title, I don't think, or tidy. So basically, like, where we see this contributing. So this is. It relates to 2 issues, basically. So it's a classic concept. Wealth is a classic concept in economic history, but also in economics, right? So Adam Smith's, the first edition of Inquiry into the Wealth of Nations, but also Walt Rostow's, Stages of Economic Growth or Development. Can't remember the exact title, but he's concerned about, capital investment and, how would he define a takeoff? So that's a classical debate. And there's also this more general environmental debate about, like, how do we measure sustainability, and these are kind of issues that we're kind of interested in. So in terms of the classical wealth debates, it's like, how rich are countries, how do they compare against each other, so how do you actually quantify this and measure this, and then what exactly are the components of wealth, so how is wealth distributed amongst different capital assets. But in terms of the environmental debate, when it comes to measuring these things, the way we do and the way Kirk and the World Bank have done, it's this big debate between strong versus weak sustainability. So the idea of strong sustainability is that if you have critical thresholds in your natural capital, and once you go beyond that, there's no coming back. Whereas weak sustainability assumes a level of substitutability between different forms of capital. And this is kind of... we don't really solve this, we kind of brush over, but we're aware of the issues, and it's kind of difficult for us to fully get to grips with, but substitution of natural capital is obviously a big issue here. For this particular paper, it's kind of motivated by Pezzi and Burke's paper, where their issue is about the scale of the indicator, because genuine savings for a lot of countries says they're on a positive or sustainable development path, but a lot of the environmental indicators are saying actually no, you're on a negative one, so like your carbon footprint, etc. So what Pezzi and Burke decided to do was actually, let's look at this from a global level. So this is a point raised this morning. We have, like, different levels of scale, local, national, global. So what we decided to do was to make a global, which is essentially just an aggregation of everything we have, compare that with the national experience. And so that's kind of the motivation, essentially. Now, when it comes to genuine savings, a lot has been said. I don't really have to, or I don't think I can add any more than what's been said. But basically, we're kind of inspired by these wealth accounts. So these are comprehensive or inclusive wealth, depending on your terminology. And what we're trying to do is look at the change in the wealth. So that's your genuine savings or your comprehensive investment, whatever way you want to label that. And what the theory tells us, so Marty and Kirk are very heavily involved in the theory side of things, is a link between future well-being and changes in wealth. And the theory shows that there's a link between this. And then this is where we, normally I don't, I'm in a room where I have like Marty Weitzman and Kirk Hamilton and the Hartwig rule himself, so I don't want to do it this justice by trying to explain it. So the Hartwig rule is essential. Yeah. So I'll leave it there, right? But basically, the assumption behind all this is that there's elements of substitutability between your different capital stocks, and that you're able to put a monetary valuation on natural capital. These are hotly debated topics because I work with a lot of environmentalists who would argue that you can't actually substitute your natural capital and that you shouldn't put a monetary valuation. So they're not something that should be brushed away. So we are aware that there's limitations of this. But the whole idea is that, well, if you're going to fail your weak sustainability, which is what we're going to show you, in all likelihood you're not going to pass the strong sustainability test. So inherently there's nothing wrong with what we do. When it comes to empirical estimates, so this is something I've kind of looked at what different people have done and over different studies. For this kind of what we're doing, there have been a lot of studies. So Kirk Hamilton and co-authors have brought this back to the 1970s. Some people decided to do it for like a 5-year period. Some have done it for longer. Some people have done it for specific countries, and some have done it for like the entire globe. But what you do see in a lot of these studies is that there's a trade-off between the scale and the scope, right? So you can get a lot of countries, but the data quality isn't going to be great. Or you can do one country in a lot of detail, but then it's not really comparable across countries. So this is kind of the trade-off you have to do. And the definitions vary. So when I was doing a survey of this, what we found was that a lot of people would call what they call genuine savings and green savings were used interchangeably, but sometimes it just meant adjusting for natural capital. In other times, it meant trying to incorporate human capital into this. Technological change is an important concept here as well, right? So this is what we refer to as the seminal Weitzman paper. In 97, Kirk had a different one. And then like Pemberton and Love. So this is the idea that, you have to take account of technological change, especially if you're going to look at something over the long run. So this has been included in a number of studies, so Pezzi et al., Motta and Dominguez and Gracie et al. And the idea here is, especially when it's incorporated in empirical estimates, but it's trying to bring in total factor productivity into this discussion. And basically what it's saying is you have your given number of assets, but you can actually get more return on the same assets if you can have some kind of exogenous technological progress. This is a bit of a debated issue, is carbon damages. And this is where we try to be a bit on the controversial side, because if anyone is familiar with this literature, the range of estimates are very broad, right? So conventionally, we could have just used toll. So toll tells us that it's probably around $27 per ton of carbon. But Pezzi and Burke re-estimate the underlying DICE model, right? So they come up with 131 tons of carbon if you assume that there's optimal controls, and this is in the future, so discounted back. But if they assume there's no controls, they get this really high, and it's not very high in terms of the distribution of what these prices can be, but it's much higher. So just bear in mind, that's the price that we've decided to go. We've gone with the lower bound, not the upper bound. What we've constructed, and these are consistent across the countries. The first step is Neff Net Investment. So that's next fixed capital formation plus overseas investment. And these are being constructed, especially for the countries that we have, by leading historians who've spent years doing this. So I wouldn't even call them historians, actually. So Simon Kuznets is one of the pioneers for the United States. We have Charles Feinstein for Britain. We have Butlin for Australia. A lot of scholars just devote a lot of time to estimating these, and it's probably the most important part of this. We then look at what happens when you make allowance for the depletion of natural resources, including forestry. For our aggregate or global estimate, we've added in the cost of carbon emissions because I think this makes more sense for a global scale because it's a global externality. So we've incorporated that into this. To be consistent with the adjusted net savings, we've incorporated, we attempt to make an allowance for changes in human capital as well. We estimate GS-TFP, which is going to be our genuine savings plus the value of changes in technological progress, which is proxy for by TFP. And then, this could be double counting because we already have education. And if we don't account for education in our TFP, so we've added TFP to green. So we try and make it a bit as broad as possible if we can. So just to say what the countries are, for the developed countries, we've got United States, Great Britain, France, Germany, Switzerland, and Australia. So this is building on existing studies that we've done. So Greasy et al. Looked at Britain, Handy et al. Looked at Germany, US, and Britain. And then we incorporate Latin American countries because this is where Cristián's come up with new estimates of capital stock for various countries. As I said before, we get the idea from the TFP from Weitzman. Pezzi et al. From 2006 incorporate this for Australia. And we get most of the underlying data from Greasley and Madison, who look at TFP across, I think it's mainly OECD countries from 1870 to 2000. And then we incorporate CO2 using this Pezzi and Burke price and carbon emissions. Now this is the bottom line or the takeaway figure, so our main figure. And basically what we're saying is, so if you don't buy the technological progress, that's fine. But what we're saying is, aggregated up across countries, this is what we get. So this is per capita basis in 1990, Geary Camus dollars. But the main events are main historical events that we know about, right? So we weren't really surprised when it doesn't show up in the aggregate one, but it's the Great Depression and the Second World War, major dislocations. And we start, for our green measures, it's later in the series that we start to see lower values. These are just simple summary statistics. I think it's the average over the whole period and then by subsamples. To put this in context, Kirk Hamilton had a paper where he looks at the counterfactual, what if all these countries followed the Harpic rule? And his take home was that there's a possibility of unbounded and rising consumption if a GS rate was about 5% of GDP, and this is maintained over time. So what we find is if we just look at net investment for our whole sample, that's fine. But when it comes to green, it's a bit lower. And then when we incorporate the CO2 estimates, it's lower still. And the interesting thing, I guess, and this is just, how we incorporate CO2, but in the later period when carbon emissions are increasing, that's when the green is decreasing. So overall, from 1900 to 2000, 3.74, but from 1946 to 2000 is 3.58. Now, if you want to be more optimistic, say we haven't incorporated, human capital in this, well then we put in our education and it goes above 5%, and TFP then will dominate the story if we allow it, I guess. Now, what happens when we do it by individual countries? So this is all the countries in the sample, right? So Britain, Germany, US, etc. So we get some interesting patterns here. We note that most of them aren't negative. The only one that's negative is Chile, which starts out with a very low net investment rate, which partly explains it. The Latin American countries perform less well on the TFP measure, and that's because they have lower TFP growth than the developed countries. And this is just by, some examples. So this is, we put in UK, US, Argentina, and Chile to show you, what the trends are like and how these differ from the global or the aggregate figure that we constructed. In terms of, so it's, I guess, the way we've written at the moment the role of technology has become quite important, and I guess it's how we estimate the measure. So it's the present value of TFP's contribution to future income growth, and so this is, this could be, partly why it's reflecting the trend it does, but it's mostly an upward trend for the developed countries. So the way we've interpreted so far, and we might get some more comments on this, but generally over the 20th century, we're seeing TFP representing some kind of intangible capital that we haven't captured, but it's showing accumulation of this kind of wealth over time. In contrast, the Latin American countries have a much lower TFP rate than what we found for the developed countries. So this is kind of driving why Latin American countries have a lower rate and sometimes have negative. So the Chile stands out, Mexico as well. So Mara Rubio has a paper about Mexico, and in her paper, it's basically why did Mexico have a negative genuine savings rate for so long, and how come it didn't collapse? But she's arguing that it was TFP in terms of trade that kind of explained why Mexico, didn't collapse in the long run. So anyway, just to summarize, and I think I go to time because the green light's still on. The main trends, well, we have high differences between developed and Latin American countries. The gap is even bigger between resource-rich countries, so Chile would be an example of that, and countries that aren't abundant in natural capital. We've added this in here. Preliminary GS measures are kind of contradictory to what the GDP per capita estimations kind of tell us. So this is the traditional Angus Madison data set. It gives a bit of a more nuanced take on the 20th century. When we include CO2, we get maybe aggregate losses of about 1.5 to 1.2% of GDP. So obviously we could do some improvements in this. So one idea is, well, would it make a difference if we looked at net savings or if it's investment? What about CO2? Should it be included or not? Is this a good metric for global sustainability? And maybe try and get down to the root of what's happening with Latin American TFP. So maybe some new TFP estimates. But that's it. So, great.
Thank you very much, Eoin. We're going to continue with the soft Irish accents and hopefully continue with keeping so well to time. This was a really enjoyable paper to read, indeed to read several times. And my first comment was exactly the same as Ed's on ours, which is this is a paper that's trying to do 4 different things. So my reflection on the paper and what I would urge the authors is that they've done so much interesting data work that the work is in bringing out the value of it fully, both in the chapter and, since it won't accommodate everything they have to learn from their own data, in further work. So the paper extends estimates of genuine savings back to 1900 for a substantial range of countries, incorporates carbon into the picture, adds intangible assets via the total factor productivity measure, and brings these all together to provide what's being referred to as an aggregate global picture, as well as the very interesting trends for the individual countries that we saw. So I think each of these is a real contribution and deserves a significant discussion in the paper, and perhaps they're all rather crammed together in a sense at present and need to be disentangled a bit and discussed in more depth. In terms of, first, the genuine savings going back to 1900, so the results are very strong in that they suggest that taking resource extraction into account affects the picture for some countries for some periods, globally reduces the average rate of investment of genuine savings by about 1/3. But that's pretty much fully compensated by investment in human capital in terms of education spending, especially in the second half of the century. If indeed, as Eoin said, if we think that one can compensate the other, and that's something that obviously has been discussed at great length in the development of this framework, but it's pretty central to these numbers. One detail on the resource extraction is that renewables and non-renewables are treated the same way, and that they're both valued at current market prices. It wasn't obvious to me that those were the only options or necessarily the best way to do it, but again, these are issues that have been much discussed in this framework. Just stepping back from those figures that flashed up before you, I was surprised, maybe I shouldn't have been, that the first half of the century looked so similar to the second in almost every respect, except that there was more investment in education in the second half. And I think that takes some, would merit some time being spent on it. Moving rapidly along, incorporation of CO2 into the picture reduces the rate of genuine saving or investment by about 1% globally on average per year. The very, very wide range of estimates of social cost are referred to, and Owen referred to them in the presentation. It wasn't entirely clear to me what exactly had been done in the paper, but also it wasn't clear to me that the sort of threshold effects that Rick van der Plug referred to earlier were, in terms of carbon tipping point, I've been going to too many presentations that Cameron makes to miss this point, and that these sort of threshold effects don't seem to be fully incorporated here. It also wasn't entirely clear to me, or the rationale wasn't advanced as to why this particular form of environmental damage is being included. Maybe it's because we have the numbers, whereas others, such as other damage to the natural environment, species destruction, and so on, why they're not featuring. And moving rapidly on to the treatment of what are called, being labelled, the incorporation of intangible assets. Well, you'll have seen that this makes an enormous difference to the patterns over time, over the century. The implications are thrown out, if you like, rather than discussed. I mean, there's a couple of references to taking a sanguine view. If we continue to adopt technological solutions, we may continue on a sustainable path. But that I think, compared to what was up on the slide, if you just looked at the slide, you would say we have every reason to be extremely optimistic. And maybe labeling it technology in some points in the paper is narrowing what is actually meant by it as is recognized in the paper. But I thought the implications of those numbers really need to be both discussed here and then teased out in the chapter. It wasn't entirely clear to me how the TFP figures had been used, but I think we need to hear a lot more about what assumptions are being made as we look forward, and what the implications are in terms of, for example, how we then regard the climate change difficulties that we undoubtedly face. Final point, and not to throw a spanner in the works, but the very nicely explained presumption here that we also had earlier very elegantly explained in earlier presentations, that what Cameron was referring to as the base on which to build the wealth edifice, that this was sustainable consumption, the net present value of future consumption. But that clearly isn't the only thing that one would want to, that one would consider in terms of a measure of well-being. And there are now, I think, much firmer methods of trying to monetize other aspects of well-being than consumption, that no longer are as soft as I think I heard somebody describing them on the bus as we drove here this morning. There are harder ways, or more concrete ways of getting at broader measures of well-being that incorporate, for example, life expectancy or indeed inequality, and that aren't that if we're extending the wealth concept, maybe we should be also extending the welfare or well-being concept. But really, really nice paper with lots of work, and look forward to seeing the version in the book.
Well done both. Time for questions now. Kirk, comments?
I know it's
you're using a price of over $100, right? And you only get to 3%. So I'm just raising a question. Might go back and take a closer look at it.
So we discount the price from the 110 back to 1900, so it's not a constant price.
Oh, sorry. Okay, so you're going. Yes. Okay. So you're saying.
So like what Toll says.
Okay, so it's not a fixed.
No, we don't do a fixed price.
Okay, thank you. That clarifies.
Marty.
I once did a paper, about 15 years ago or so, where I attempted to piggyback on Kirk's World Bank figures, and Kirk and his team had examined 12 minerals, oil, maybe 2 types of coal, natural gas, copper, zinc, whatever, 12. And I attempted to find what was the hoteling rent on it. Oh, you needed lots of assumptions. But basically, what was coming out was that even if you treated this as a pure depletion problem, and it's not, it's more complicated because new findings are coming in to take the place of the old reserves, it wasn't adding up to very much. Also, using this kind of way of looking at sustainable equivalent consumption, it was making a difference in sustainable equivalent consumption of less than 1% for all 12 minerals taken together. So on a world level, as opposed to a country level, this is not big potatoes. Somehow these numbers are trying to tell us their market values for the prices and the costs and so forth. They're trying to tell us that this is not a big deal, this running out. We will substitute. See, that's a dual side to the way you might think you would try to figure this out. You might try to figure out whether we're on a sustainable path and how much it's costing us by making direct estimates of future production and this, that, and the other thing. It requires a million assumptions. If you use this dual side, it sort of gets around that because the market price is allegedly capturing all that. Anyway, it was not amounting to a big amount at all for the world as a whole. So the story it was trying to tell, I think, was that running out of all these mineral resources, putting in there, depleting net national product by them, was not really changing the big picture at all.
But what might change is, and you discuss climate change, but you don't discuss biodiversity.
Yeah,
and so you can run out of lots of minerals like oil and stuff like that, and you can think of technical substitutions, new materials, all that sort of thing. But I'm amazed. You have a long discussion about whether it's $27 or 100 and something, but you have this amazing renewable natural resource, which if you're deprived of, you have no economic growth, and yet it doesn't go into the calculations at all.
Yeah.
Because nobody knows how to do it.
Yeah, but it means the numbers are somewhere else.
Still might be quite high.
All of this field, I just continue for 1 second. I mean, it's a compromise. Starting from Kuznets, it was a compromise. There's some stuff we can measure harder, firmer. There's other stuff which is loose, and Kuznets made what I think is a wise decision, and has been followed by others. That look, we're only going to include stuff where there's a minimum of controversy about what this is. Then we'll treat these, we admit that there are these other subjective things. There's happiness, there's healthiness, but we're going to try to leave them separate, sort of, because depending upon who's estimating this and how they're estimating it, we'll get wildly different numbers. So I think this tension is always there, and it's not always a good idea, frankly, to try to make it so inclusive and things like biodiversity, Lord knows what should be the proper weight on that.
Yeah, especially if you want political acceptance of the robustness of your numbers. But there's a long debate in the literature, obviously, going back 30 years, whether some number is better than no number. We're running fast out of time, but Glenn-Marie, and Michael, did you have your hand up?
One thing on the genuine savings that is useful is that breaking that down into the different components is very helpful when you want to talk to countries and ministries about what do you actually do to increase wealth. So it's helpful with that as an expository device. I wanted to ask about how you might break down that total factor productivity contribution. One is you mentioned you use gross fixed capital investment, which of course that was the only thing that was available 100 years back. But it's now changed, and it does include, the measures, at least in theory, are supposed to include software, which many people do, countries do, but also R&D. And that would have become much more important in the last couple decades. Of course, it would change your time series, but that would be one thing to move away from gross fixed capital formation. The other thing, just to try to explain a little bit, is that we've always used the expenditure on education because we don't really know how human capital is changing, although Kirk's going to talk about a new database where we might be able to do that. But we think pretty much that the spending on education is a lot less than the change in human capital. So this TFP could be picking up some of that. You might look at some of the countries that have done a time series using the lifetime earnings approach of Jorgensen-Fromeni at human capital, just to see the difference. So you won't come up with a different number, but you might be able to say, what's the order of magnitude and how it might impact.
Great. At the risk of riling the group, I'm going to cut things off there so we don't run out of time. I hope we might be able to pick up some of the kind of intangible TFP questions in the panel in about an hour. But right now, thank you very much, Eoin, and we are moving on. Thank you.